it doesn't matter how high prices go up. They always have to keep going up, right? So if we have 1 year where prices go up by 50% in 1 year, the Fed wants to make sure that next year they go up another 2%. So you're at 52% and then 54%, right? We can't have prices go up 50% and then go down by 10%. Oh no, that'd be a disaster. We can't allow that. This is what Powell is saying. We do need lower prices. We need much higher interest rates to bring the price level back down. Instead, what Powell wants is, he said, it's going to take a while. We need wages to catch up to prices, right? And that way people can afford. So in other words, he wants more inflation so that people can get higher wages to afford the higher prices that resulted from the inflation of the past.
In a recent discussion, renowned economist Peter Schiff shared sharp insights on the Federal Reserve's flawed approach to inflation and monetary policy. He argues that the Fed's insistence on maintaining rising prices, even after massive spikes, only perpetuates a destructive cycle of inflation. Schiff highlights the absurdity of the system, where a 50% rise in prices 1 year is followed by policymakers insisting on another 2% increase the next, rather than allowing a healthy market correction. According to him, real economic stability requires lower prices and higher interest rates to bring purchasing power back into balance. However, current policy, as led by Chairman Jerome Powell, focuses on letting wages catch up to inflation, which Schiff says is effectively a call for more inflation. Instead of fixing the problem, this mindset fuels a self-reinforcing loop. Prices climb, wages follow, and the dollar weakens even further. Schiff warns that this illusion of progress, where people feel richer but their money buys less, is one of the most dangerous economic traps of our time. True recovery, he insists, would come not from printing and spending more, but from letting markets reset naturally. Don't forget to like, comment, and subscribe for more financial insights.
One of the things that happened today in the market as a reaction is bonds got clobbered, and yields on the 10-year to the 30-year shot up as a result of the rate cut, which is, again, something that I had been forecasting. And I think that you're going to continue to get more increases between now and the December meeting. So I think that rates will be higher when the Fed meets again in December than they were in November when they cut. And so they're lowering short-term rates, but long-term rates are not cooperating. They are going up. He specifically said that gold was his barometer of whether or not he got interest rates correct. That even though we weren't on an official gold standard, unofficially we were, because Alan Greenspan still looked towards the price of gold as a market indicator of whether or not rates were too high or too low. And so what he told Congress was $400 gold meant he was too loose, and $300 gold meant he was too tight. And so he was kind of eyeing for around 350. And so if the price of gold stayed around 350, that would indicate to him that he had got interest rates about correct. Well, if $400 gold meant that Greenspan was too loose, what does $4,000 gold mean now? What is that saying about the Powell policy? Clearly, if 400 represented too loose money back in the 80s, well, then 4,000 certainly must represent the same thing in 2025. And the balance sheet is $6.7 trillion, and the Fed says we're not making it any smaller, which proves that Ben Bernanke lied or just was completely incompetent if he actually believed what he was saying. I at least was smart enough to know that what he was saying was impossible. But at least somebody should officially come out and say, okay, we are monetizing debt. That's what the Fed did. That's what it continues to do. And so we are no better than a banana republic. We are, in fact, a banana republic. The only difference between America and a banana republic is the bananas, right? We don't got them. And now, if we want to buy them, of course, we got to pay tariffs on them as we import them. But that's a significant development that there's an end to quantitative tightening. I'm surprised it took them so long. I actually thought they would have ended it a while ago. In fact, I thought they would have gone back to quantitative easing by now. Now, I believe that that's coming. We'll probably get that next year. And I think stopping quantitative tightening is just the first step to initiating quantitative easing. Also, what the Fed mentioned is that to the extent that bonds mature, they will continue to roll over the principal. But if it is a mortgage-backed security that matures, the Fed won't roll that over into more mortgage-backed securities. It will roll it into treasuries. Powell said is that, look, once these tariffs work their way through the system, we don't have to worry about them anymore because it's just going to be a one-time increase in prices, and it's not necessarily going to repeat. And so we don't have to worry about it if it's only a one-off event. We're worried about a continuous increase in price. And I think the Fed knows that the economy is a lot weaker than it lets on in public. So I think we're going to get a cut, but there is now some more uncertainty, which should be weighing on an overvalued market. The stock market hit new highs again today. The NASDAQ, in fact, the NASDAQ was, I think, the only index that managed to close positive today. And so another record high. The other indexes were all down, but they weren't down dramatically. Maybe the Russell 2000 was probably the weakest of the bunch. But it could have been a lot worse, given that this was a hawkish cut, right? To the extent that you could cut rates and be a hawk, right? Although, there's nothing hawkish really about anybody on the Fed anymore. Even the hawks are doves. As expected, the Federal Reserve announced the official end to its quantitative tightening program, QT. That's going to end in December. And last I checked, the balance sheet is about $6.7 trillion right now. Now, if you remember, before the 2008 financial crisis, it was below $1 trillion. I don't remember the exact number, but it was less than $1 trillion. And it blew up pretty big. So by the end of QE3, before they started to shrink the balance sheet, it peaked out at about $4 trillion.
In a detailed market breakdown, Peter Schiff examined the recent reaction to the Federal Reserve's latest rate cut, a move that sent long-term bond yields soaring while short-term rates fell. This divergence, Schiff explained, signals a deep disconnect between monetary policy and market reality. Despite the Fed's efforts to control the curve, the bond market isn't cooperating, and long-term investors are demanding higher yields. He pointed out that historically, even Alan Greenspan looked to the price of gold as a gauge for proper rate levels, with $400 gold meaning loose policy and $300 indicating tightness. Now, with gold soaring toward $4,000, Schiff suggests the U.S. is facing extreme monetary excess. The current $6.7 trillion balance sheet confirms what he has long argued. The Fed has been monetizing debt all along. With the official end to quantitative tightening, Schiff predicts it's only a matter of time before quantitative easing returns, perhaps as early as next year. He warns that despite market optimism, the U.S. economy remains weaker than the Fed admits. What looks like stability today could be setting the stage for the next monetary storm. Let's get into the interview.
The NASDAQ has made a new high just about every day, yet Bitcoin doesn't do that. So Bitcoin's not going up with risk assets. It's not going up with risk-off assets. It's just drifting down. But if we get a bigger correction in the NASDAQ, which we obviously could have at any moment, or a big rise in gold, because Bitcoin is negatively correlated with gold and positively correlated with the NASDAQ. But I think we're setting ourselves up for a big drop in Bitcoin. So it'd be a great time for you Bitcoiners to go cash out your Bitcoin and get some of the gold on my new platform. And then you'll be able to use your gold in ways that you could never use your Bitcoin. It'll actually work. It'll actually solve the problems that Bitcoiners pretend Bitcoin can solve, but that it can't. And, when it comes to Bitcoin, too, I've never seen a consensus trade where there was more faith that you couldn't lose. There's so much conviction in Bitcoin Not only do they think they can't lose, but they're guaranteed a huge gain. Bitcoin's not just going to go up. It's going to 10x. It's going to 100x for sure. You can't lose. And, you've got the president behind you. You got Wall Street behind you. I mean, you've got everything going right for Bitcoin. Nobody is negative. When you get a market like that, it really can only go in one direction because everybody already owns it. Since it's so obvious Bitcoin can only go up, then why would anybody not own it? Why would the people be waiting to buy it? They just buy it now. So everybody is already in. And so the question is, who's left to get in? Nobody. Well, what happens when people want to get out and there's no new money coming in? The bottom drops out. That's where we're headed. Donald Trump talks about how these tariffs are great for American workers, right? We need these tariffs to protect American workers, right? Well, all workers are also consumers, right? So the workers that Trump wants to protect are also consumers. So they are also harmed by rising prices. But if you just forget about that, if you assume that maybe the tariffs will help them get a bigger raise so that will more than offset higher costs. In America, we have about 12 million people that work in manufacturing. 12 million. That's out of a total population of workers of over 163 million. So about 7.5% of the U.S. workforce is in manufacturing. So at most, that's who's going to benefit from the protectionist tariffs. In theory, of course, in reality, they won't all benefit. A lot of them won't. A lot of them will lose their jobs because they're going to work at companies that will be less efficient as a result of these tariffs. But even if you assume that all 7.3 million got a raise because of tariffs, right? Because their employers were able to raise their prices because they had less foreign competition. And because they were able to raise their prices, they were able to pay their workers higher wages, right? So you have a small number of workers who benefit, but only because their employers could raise their prices on a huge number of workers.
In his latest analysis, Peter Schiff draws sharp attention to the growing cracks in both digital and traditional markets. Despite the Nasdaq hitting new highs almost daily, Bitcoin continues to drift downward. A troubling sign, Schiff notes, since it isn't rising with either risk-on or risk-off assets. This disconnect suggests that Bitcoin's strength is built more on sentiment than substance. As he puts it, when everyone already owns an asset and believes it can't lose, there's no one left to buy. Only sellers waiting to exit. He warns that the market's blind faith in endless gains sets up a dangerous scenario where the smallest shift in sentiment could trigger a collapse. Meanwhile, Schiff also highlights the economic irony behind protectionist policies. While tariffs are promoted as a tool to protect American workers, they inevitably drive up consumer prices. Even if some manufacturing jobs benefit, the broader public pays the price through inflation and reduced purchasing power. In Schiff's view, both Bitcoin optimism and tariff-driven nationalism ignore the same fundamental truth. Artificial support always ends in correction. The real winners, he argues, will be those who protect their wealth with tangible value, not paper or digital promises. If you found this insight helpful, make sure to like, share, subscribe, and comment below to stay updated with more market discussions and economic breakdowns.